Welcome traders. Today we're diving into the critical lessons that will take your trading journey to the next level. If you've ever struggled with inconsistent results, emotional decisions, or psychological barriers, you're in the right place. This isn't just another trading video, it's a roadmap to understanding the biggest mistakes traders make and, more importantly, how to fix them. Stay with me because every minute of this video is packed with strategies, insights, and real-world examples that could transform the way you trade. Let's talk about one of the biggest trading mistakes, using too many indicators. Take a look at this chart. It's cluttered with moving averages, stochastics, RSI, Bollinger Bands, and Fibonacci retracements. It's chaotic, overwhelming, and hard to make sense of. How can anyone make a clear trading decision with this? Now, let's clean it up. Remove all the indicators. See the difference? The chart is simple, clear, and easy to understand. Now we can see the market has broken above a resistance level and is pulling back to retest it as support. The picture is straightforward, and we can better predict what's likely to happen next. This mistake happens because of something called analysis paralysis, a psychological state where overthinking leads to confusion and indecision. Here's why it happens. First, fear of being wrong. Many traders overload their charts with indicators because they're afraid to make mistakes. They believe that more tools will give them more confidence, but in reality, it just creates hesitation and doubt. Next, a lack of trust and simplicity. Some traders think that trading has to be complicated to work. They dismiss simpler strategies, like price action, even though they're proven to be effective. Finally, overconfidence in indicators. Indicators can create a false sense of security. Traders rely on them too much, thinking they can predict the market. But remember, indicators only show what's already happened. They don't tell you the future. So how do you overcome analysis paralysis? Use one or two trusted tools, like price action or Fibonacci retracements, and don't clutter your chart. Keep it simple. A clean chart gives you clarity. Fewer distractions mean better decisions. Now, let's discuss a common mistake many traders make, ignoring the bigger picture. Let me walk you through how this happens and why it's so important to address. Take a look at this New Zealand US dollar 5-minute chart. On the 5-minute time frame, we've identified a strong demand zone. The zone is fresh, the move is sharp, and the candles are large, all the signs of a solid setup. The reward to risk ratio looks excellent. Once the price approached this demand zone, it was rejected, creating a liquidity sweep. So, we entered the trade. But as you can see, it didn't work out. Why didn't it work? Not because the supply and demand trading strategy is flawed, but because we ignored the bigger picture, the higher time frame. Let's revisit the setup with a fresh perspective. Switching to the hourly time frame, we notice what we missed. The market was rejected from a strong supply zone. This supply zone is a conflicting signal, suggesting that the market is more likely to move downward and reach the demand zone visible on the hourly time frame. Now, going back to the 5-minute chart, even though the demand zone appears technically strong, we're trading against the higher time frame supply zone. This conflict in signals is why the setup ultimately failed. This is a classic example of a psychological issue known as tunnel vision or narrow framing. This happens when traders focus too much on one small aspect of the market, like a specific time frame or setup, while ignoring the broader context. It's a cognitive bias that leads to short-sighted decisions, often driven by impatience or the desire for quick results. So how do you overcome this psychological bias when trading? It's simple. Always use a top-down analysis to incorporate the higher time frame into your strategy. Here is how you can apply it. For trades on the 5 or 15-minute time frame, analyze the hourly chart to understand the broader trend. For trades on the hourly time frame, use the daily chart as your higher time frame. For trades on the 4-hour chart, check the weekly chart for the bigger picture. For traders on the daily chart, analyze the monthly to understand the broader trend. This process helps you align your trades with the market's overall direction and avoid setups that conflict with higher time frame trends. Now let me share with you a secret why your trading strategy will never work, even if it has a 99% win rate. Trading isn't just about strategy, it's a battle of nerves. The market knows how to play on your emotions, and if frustration or fear takes over, you'll fall into its trap. Let's dive into this real chart example. You've identified a strong demand zone. Everything checks out. The candle size is significant. The zone is fresh. There's a clear breakout of structure, and the risk-to-reward ratio is excellent. Confidently, you place your buy trade with a stop-loss set just below the demand zone. But then it happens. The market dips lower, breaking below the demand zone, and then your stop-loss is triggered. Frustration starts to creep in, right? It feels like the market is out to get you. But here's the thing, this isn't random. What you just experienced could be a classic liquidity sweep, a smart money move designed to trigger stops and collect liquidity. Here's the moment of truth. Will you react emotionally and walk away, or will you approach this like a pro? Let's see what happens next. The market returns to the demand zone, and this time it closes above it. This is your cue, a clear signal that the initial dip was likely a liquidity grab, not a true breakdown. Now you have a choice. Let the frustration of that first loss hold you back, or calmly re-enter the trade. Here's what a disciplined trader does. You re-enter, but this time you refine your approach. Place your stop loss just below the new low of the demand zone and set your sights on the next target level. And guess what? The market moves in your favor, climbing to your profit target. That's a win, not just because you made money, but because you outsmarted the market's mind games. This scenario isn't a one-time event. It's something you'll encounter often, no matter what strategy you use. Whether you're trading supply and demand zones, Fibonacci retracements, or any other method, the market will test your nerves. Here's how to stay composed and handle it like a pro. When your stop loss is triggered, avoid rushing to react. Take a moment to step back and evaluate the situation. Ask yourself, is this a liquidity sweep designed to trap traders, or is it a genuine breakdown? Remember, observation always outperforms impulsive reaction. Always have a clear re-entry plan. For example, in a supply and demand scenario, if the market closes back above your demand zone after the dip, that's your signal to re-enter. Make your move strategically, keeping emotions out of the equation. Now let's talk about a trading mistake that can drain your account faster than you realize. Projection bias. This happens when traders assume the market is too high or too low and expect a reversal without solid evidence. The problem? The market doesn't care about your assumptions. Let me show you how this mistake plays out and, more importantly, how to avoid it. Here's how projection bias works. The market is trending up, and you identify a resistance level. You think the price is too high, it's bound to reverse here. So you enter a sell trade, expecting the market to turn around, but the market doesn't reverse. It breaks through the resistance and keeps climbing. Frustrated, you take another sell position at the next resistance level, convinced it will reverse this time. But once again, the market continues upward, and the losses pile up. The same mistake happens in a downtrend. Traders assume the market is too low and expect a bounce, entering buy trades prematurely. The market, however, breaks through support levels and keeps falling, leading to even greater losses. This isn't bad luck, it's projection bias. Traders project their personal beliefs onto the market, expecting reversals without solid evidence. The market doesn't follow your expectations, it moves based on supply, demand, and momentum. To overcome this mistake, shift your mindset. First, understand that the market is never too high or too low. Trends can extend far beyond what feels reasonable. Second, rely on evidence-based analysis. You can use tools like price action, breakouts, or candlestick patterns to validate your trades. Third, always wait for confirmation before entering a reversal trade. Look for clear signals like a shift in market structure or rejection at a key level. Remember, trading is about aligning with the market, not forcing it to fit your expectations. By avoiding projection bias, you'll make smarter, more disciplined decisions. Alright, let's dive into a mistake that's far more common than you might think, and it can happen no matter what trading style you use. So here's the situation. You're watching the charts, and you spot the perfect supply zone forming. The setup looks solid, the kind of trade that feels like a no-brainer. But then, something distracts you. Maybe you get a notification from a trading group hyping a different market, or you start scrolling through social media and see someone posting about massive gains they just made. You feel it, that itch. What if I miss this trade? You rush to place a limit order on the supply zone, assuming it's bound to work. You don't wait for confirmation. You're convinced the market will respect the zone and move in your favor. But when you check back, the frustration sets in. The trade failed. Maybe your stop loss was hit, or the market didn't react the way you expected. Here's the hard truth. This wasn't just bad luck, it was bad trading. By acting on the fear of missing out, you skipped a critical step. Confirmation. Let's be clear. The supply zone is only one part of the strategy. Who said the market must respect that zone? Trading isn't about guessing, it's about aligning all the pieces of your strategy before entering a position. If you skip steps and rush into trades, you're not trading, you're gambling. So, how do you avoid this trap? Shift your focus from fear to strategy. Opportunities are everywhere in the market. Missing one trade isn't the end of the world. Another opportunity will always come, whether in 5 minutes, an hour, or tomorrow. The market never runs out of setups. Always wait for confirmation. Whether it's a break and retest, a price action signal, or any other indicator, always ensure the market validates your zone before you commit. Confirmation isn't optional, it's essential. Trust the process. Every strategy, from supply and demand to Fibonacci retracements, works best when you follow it to the letter. Rushing a trade because of FOMO only sabotages your chances of success. Take a look at this chart. Here we have a clear range-bound market. The price breaks out of the range, pulls back, retests it, and gets rejected, forming a clean pin bar signal. You place your entry. Carefully set your stop loss just below the pin bar's lower tail and define your target. Everything looks perfect. But what happens next? The market easily hits your stop loss, only to reverse and move exactly in your favor, all the way to your target. Sound familiar? It's frustrating, isn't it? You did your analysis, identified the right setup, and yet you still lost the trade. Why? Because your stop loss was too narrow. You didn't give the trade enough room to breathe. This isn't just a technical mistake, it's a psychological one. This mistake stems from a human psychological tendency called the illusion of control bias. In trading, the illusion of control bias makes you believe that using a smaller stop loss minimizes your risk. The logic seems simple. The closer my stop loss is to my entry, the less money I'll lose. But this is an illusion. A narrow stop loss doesn't reduce risk. It increases the chances of being stopped out by normal market fluctuations, even if the trade eventually moves in your favor. Why does this mistake happen? The first reason is fear of loss. You might think that using a smaller stop loss will protect you from losing too much. But in reality, it ignores the natural volatility of the market, which needs room to breathe. The second reason is overconfidence in precision. You believe you can perfectly predict where the market will reverse, so you place your stop loss too close to your entry. This doesn't account for the normal movements of the market. And the third reason is ignoring market noise. Small price fluctuations, what we call market noise, can easily trigger a tight stop loss, even when your trade setup is still valid. Here's the truth. The distance of your stop loss doesn't determine the true risk of your trade. True risk is calculated based on 3 factors: position size, percentage of account at risk, and reward to risk ratio. Let me break this down with a simple example. You've identified a trade setup and are ready to place an entry. You decide to risk 2% of your $10,000 account, which equals $200. Now, let's start with a tight stop loss. You set it at 10 pips with a position size of 2 standard lots. Since each pip equals $10 per lot, that's $20 per pip in total. If the price moves against you and hits the stop loss, you'll lose $200, calculated as 10 pips multiplied by $20 per pip. Now, what happens if you widen the stop loss but still risk the same $200 on the trade? In this case, you adjust your stop loss to 50 pips and reduce your position size to 0.4 standard lots. With this adjustment, each pip equals $4 in total. If the market moves 50 pips against you and hits the stop loss, your total loss is still $200, calculated as 50 pips multiplied by $4 per pip. Here's the key difference. With the wider stop loss, your trade has more room to breathe. It accounts for normal market volatility, reducing the chances of being stopped out prematurely. Let me give you a hard truth about trading, a truth many don't want to hear. The biggest obstacle to your success isn't the market, your broker, or even bad luck. It's you. More specifically, it's your ego. Many traders, especially when starting out, fall into the trap of blaming external factors for their losses. The broker manipulated my trade, or the market is rigged, but here's the reality. The market doesn't care about you. The only person responsible for your outcomes is you. And more often than not, it's your ego that turns a small mistake into a devastating loss. Let's break this down with a real-world scenario. You've done your analysis and identified a solid demand zone. The setup is pristine, there's a liquidity sweep, and everything aligns perfectly. You enter the trade with full confidence, feeling that familiar rush of excitement. It's like the moment you hear your favorite song unexpectedly at a party. You're energized, everything feels right, and you're convinced it's going to be a great time. Profits seem inevitable. At first, the trade goes your way. The market moves slightly in your favor, and you feel validated. But then, things change. The market starts reversing. Slowly at first, then more aggressively. Now, this is where the ego trap begins. Instead of calmly assessing the situation and accepting the possibility that this trade might not work, your ego whispers, "You can't lose this trade. You're smarter than the market. Just hold on. It'll turn around." What do? You move your stop loss. A little at first, then more. Each time the market goes further against you, you convince yourself, just a little more room. It's bound to bounce back. But the market keeps moving deeper into the red. Before you know it, you've taken a massive loss, or worse, hit a margin call. Here's the reality. This mistake isn't about the trade setup or the market. It's about your refusal to admit you were wrong. It's your ego saying, "I can't lose, I have to win." But here's the truth every successful trader knows. Losing is part of trading. No strategy wins 100% of the time. The sooner you accept a loss and move on, the better positioned you are to catch the next opportunity. Alright, let me share with you 4 tips to beat the ego trap. First, accept losses as part of the game. Every great trader has losing trades. What sets them apart is their ability to cut losses quickly and move on. Think of losses as a business expense, just part of the cost of doing business. Second, stick to your stop loss. Your stop loss isn't just a number, it's your lifeline. Once it's set, never move it. If the trade goes against you, take the loss and reassess. Third, detach emotionally from the trade. Your worth as a trader isn't tied to any single trade. One loss doesn't define you, and one win doesn't make you invincible. And finally, focus on the big picture. Trading is about long-term consistency, not short-term wins. Protect your capital and live to trade another day. Let's talk about a trading mistake that can stall your progress and leave you questioning everything. It's a psychological challenge that almost every trader faces at some point. Picture this. You've done your analysis, the setup looks great, and you take the trade. But things don't go as planned. The trade ends in a loss, leaving you down $120. It's not a huge loss, but it stings. Still, you followed your process, it just didn't work out this time. You move on, spotting another promising opportunity. Feeling determined, you place your trade, carefully set your stop loss, and wait. But the market has other plans, and you're hit with another loss. Now you're down $240. This is where the fear of pulling the trigger creeps in. After back-to-back losses, self-doubt starts to take hold. You spot another excellent setup, clear, clean, and meeting all your criteria. But instead of feeling confident, your mind begins to second guess. What if I lose again? Can I handle another $120 hit? Many traders freeze at this moment. They hesitate, paralyzed by the thought of another loss, even when the setup is high quality. Fear of losing takes control, and they fail to take action. But let's imagine you push through that fear. You trust your process and take the trade. This time the market aligns perfectly with your analysis. It moves decisively toward your target, and you secure a reward to risk ratio of 7-to-1. That one trade brings in $840, enough to recover your earlier $240 losses and leave you with a $600 net profit. Okay, so now how can you deal with this psychological issue when trading? First, accept that losses are inevitable. No trader wins every trade. Success comes from managing losses and staying disciplined. Second, trust your strategy. If you've done your homework and built a solid trading plan, stick with it. Don't let short-term results shake your confidence in the process. Finally, think long-term. A single winning trade with a good reward to risk ratio can recover multiple losses. Focus on consistent execution rather than fixating on the outcome of individual trades. That brings us to the end of today's video. I hope you found the insights valuable and are ready to apply them to your trading journey. If you enjoyed this content, make sure to like, subscribe, and turn on the notification bell so you can stay updated with more trading strategies and lessons. Thank you for watching, and as always, happy trading. See you in the next video.